thanks for joining me for today's FS Club webinar. We will be discussing the findings of the GFT Banking Disruption Index, which assesses consumer sentiment towards the digital capabilities of British banks. This edition focuses on the spending and saving habits of UK banking customers. And I, for one, won't be surprised if debt has increased considerably over the last few years with a significant increase in the cost of living. It is my pleasure to introduce Richard Callis, the Customer Solutions Director at GFT. Richard helps GFT's retail banking clients address their strategic and operational challenges in the new digital economy with innovative solutions and services. Before GFT, he was a solutions architect with Mega, having held similar roles at Ubiquim, Temenos, and also leading solutions for organisations such as Metrobank, JPMC, UBS, and the Bank of England. And I'm Charlotte Dorber-Ashley, and I manage the FS Club at CN. And I'd like to warmly acknowledge our very generous sponsors, including GFT, who help us continue to bring you a wide range of thought-provoking content across finance, technology, and economics. As usual, we'll pop the slides for this presentation on our website and in the chat box. We'll record the session and it will be available to watch within 48 hours. And do use the chat box to put your questions into me, and then I can feed them into Richard after the presentation. We'll also put a link to the Banking Disruption Index report in the chat for you as well, so you can download that and have a look. Right, now it's my pleasure to hand over to you, Richard.
Good morning, Charlotte. It's a pleasure to be here again. If we can pull up the slide, that would be great. So today I will be talking about the Banking Disruption Index. It's number 6, and the headline is "Are Brits sleepwalking into a debt disaster?" So if we can move forward, please. So I'm from GFT. GFT is a platform solutions and engineering organization. We specialize in new digital banks and data analytics and artificial intelligence. We've recently expanded to 12,000 specialists worldwide, now covering 20 markets, and we've been in the operation for over 35 years. We cover all aspects of banking, insurance, AI, data, and engineering services. We're responsible for implementing some of the most notable new digital banks globally, including Mox Bank in Hong Kong, Trust Bank in Singapore, and most recently a very successful launch for Salt Bank in Romania, the first digital banking platform to leverage the core banking engine by Starling from Starling Bank. We launched that as a fully featured bank in less than 12 months, and they're hoping to take on sort of incumbents in the market like Revolut. So if we can move forward, I'll go straight in to talk about the Banking Disruption Index. So to give some background around the Banking Disruption Index, the Banking Disruption Index was launched by GFT in 2022. It was intended to address a gap we saw in the market where there were lots of surveys being done that were asking customers what they felt about their finances, how they felt about the services provided by their bank, but there was nothing that acted as a barometer to understand customer sentiment to the digital services and offerings that the banks provided, and how customers felt they compared to the more traditional methods that they had maybe been used to previously. In our initial BDI, we found that 48% of customers don't actually trust their bank to manage their finances during a recession. But no surprise, we found that 67% would prefer to use their banking app for daily needs. We also found that a little bit worrying that 77% of customers were anxious when checking their mobile banking app and looking at their balances, and they were actually preferred to liaise with their bank directly. That figure lowered when we started looking at the offerings of the newer banks, who were actually informing customers with things like notifications whenever they made a transaction, updating them of the impact that that transaction had had on their balance, so that customers were actually being kept more informed as to their financial wellness. In our third BDI, we looked at how consumers understood the charges and rates that they were incurring when actually using their banking app with Apple Pay, Google Pay, etc., and Tap and Go when they were overseas. 26% of consumers didn't actually understand any of the fees and charges that were being applied, and 32% thought that the fees were unreasonable. In later research, we actually looked at AI, and we were actually quite pleased to find out as a technology company that 61% of consumers were actually happy that their banks would use AI to support them. So if we move forward and we look at the current Banking Disruption Index, given a lot of the commentary at the moment around cost of living crisis and the UK coming back out of a short recession, we thought we'd look at customers' saving, spending habits and potential rising debt. And in BDI 6, we wanted to look at the level of borrowing and then understand how customers are actually managing to save. Are they aware of the rates and fees that they're incurring around their borrowing habits? And when we started looking at saving, we wanted to understand also, are there tools that the banks are making available to them in terms of digital services? Are they actually meeting the challenge and helping customers to understand their finances and actually incentivize or assist to actually meet savings goals? So if we can move forward, please. So when we look at the results of the survey and the borrowing headlines, it came back no surprise that 75% of customers have a credit card, and that about a quarter of those also have more than 2 credit cards, which again is slightly concerning and worrying. When we looked at the average debt that most people carried on their credit cards, the average was around £2,700. We asked about the level of concern and anxiety around the debt that consumers were carrying on their credit cards, and only 14% were actually worried about the amount that they were carrying. We also looked at payday lending, and we asked customers whether they had actually considered taking out a payday loan, and about a third of responders said that they had actually been considering taking out a payday loan in the last 12 months. We then asked about tracking the level of spending, and 39% of those that were surveyed said that they had no way of tracking their spending, and many were increasingly using their credit card and overdraft for everyday spending, and that was on everyday items such as groceries, as opposed to big ticket items like electrical goods or holidays. We found that 45% were using their overdraft before the end of the month, with as many as 25% falling into unarranged overdrafts and actually incurring additional fees and charges, which doesn't actually bode well when you start considering the level of credit card debt that consumers are also carrying. If we move forward, let's look at the saving that customers are saying they've got. No surprise, 84% of customers actually expressed the desire, but only 69% said that they were actually able to save every month. And the average of saving was around £227 per month. No surprise again, younger savers were saving the least, around £188, I believe, on average for 18 to 24-year-olds. But only 55% of 45 to 54-year-olds were saving regularly. When we started looking into older savers, we found that figure actually dropped again, even more significantly, with older savers saving less. We understand there are various reasons behind this. Clearly, as people go older, the needs of their children become more, and they often pay with university tuition, help with university tuition fees. So their ability to save would become less. When we asked responders what actually were the reasons for saving, what was their goal, what was their intent, almost half said that they were actually saving for an emergency fund. Now, this might highlight additional insecurity in the market, around jobs market, potentially around the recession, and uncertainty about what that might mean for them. We questioned whether the people preferred to save with their traditional bank or whether they preferred to save with a new challenger bank, and 44% expressed more of a willingness to save with a traditional bank and a confidence more in a traditional high street bank, with only 23% saying that their regular savings were with a digital only challenger bank. Now, before I move on, the next part of this survey actually asks consumers about the digital tools and digital services that banks make available to them to help them understand their debt, understand their spending, and to assist with saving. What I thought would be really interesting is to actually do a short survey with the audience to actually understand how you interact with your services that the banks offer you, and then we can compare them with the results of the survey. So the question is, are you aware of the digital tools and services your bank makes available to you to manage your finances?
Thanks, Richard. We'll just keep that up there a moment longer for people to answer. If you haven't answered yet, just click your option you most identify with out of the 5 on the screen. Okay.
So that's interesting actually to read. I think FS Club must have a more financially savvy audience than the general public, because we have 50% say they use them regularly, with 25% using them occasionally, which gives a headline, I would say, of 75% of our audience are actually regularly or occasionally using digital financial services to manage their financial wellness, with 25% never used and never looked for them. That's interesting. So if we move forward, Charlotte, I don't know whether you have anything that you'd like to say, whether that surprises you.
Well, I'm definitely not surprised that our audience are more sort of financially aware and savvy than general members of the public. But I for one, find it. I get the alerts as well, and I know all the services they offer, and I do find it really helpful, and it does ease the anxiety you mentioned as well, because you're not going to suddenly look at your bank statement and be shocked that there's a whole lot of money missing. Even though I wish sometimes that it wasn't me, that it was perhaps fraud, but it was all me, sadly.
So if we move forward, let's look at the results of the survey. So with the digital banking tools, as I say, we wanted to understand how consumers were actually interacting with them. Now, unlike the survey that we've just done that showed 75% interacting with expense tracking tools, we found that 40% were not actually using any form of expense tracking. 42% were actually happy with the bank's support that they were getting around understanding their credit card. And 32% were actually unsure of what products and services were available. So whilst they were there, the banks weren't doing enough to publicise or make them readily available, so that consumers understood where they were. The facilities that the banks are offering have actually started to increase the debt. So we found there was a heavy use of credit cards and overdraft, but interestingly, buy now, pay later, so installment plans, were becoming increasingly popular. And we found that £1 in every 7 being spent was being spent on buy now, pay later. So whilst neobanks have launched things like savings bots and better money management, we see new challenges in the market like Starling, Monzo, and Chase actually embedding the digital trackers, spending, insights, budgeting, savings pots. They're absolutely putting those right front and foremost of the customer experience. But when it comes to more traditional banks, we find that they're often navigate to, so they're not an implicit part of the overall customer experience. So there's obviously a lot more that can be done to help consumers more widely. Excuse me. So if we move forward. So in conclusion, we have seen that consumers are continuing to struggle with the high costs of borrowing and low wage growth. There's an increased use of credit cards and overdraft. We also see that there is a desire to save, but there needs to be more to actually assist in understanding of the spending to actually be able to drive higher levels of saving. We know that the banks and customers are starting to look at the new digital services and moving across to those, but we actually do know that there is more that the banks can do. We see that the modern new banks have absolutely been able to capture that market with the a desire to actually utilize their services, and interacting with those myself, I've heard it firsthand how engaging their customers actually find the digital financial planning that they offer them. And there are other market entrants as well that are actually making big sways, like Hyperjar with their spending pots. So actually being able to apportion segments of your actual finance to different types of spending, whether that's groceries, utilities, entertainment, and actually then spending directly from those pots. So actively encouraging positive budgeting. And we see that all as good for the market. But we do see that more traditional banks actually need to connect their customers more. Charlotte.
Thank you very much, Richard. That was very interesting. I think one thing I've noticed the most in recent years that benefits me is the ability for when you spend, the transaction rounds up to the nearest pound and puts the rest in a saving pot, and you don't even notice you're saving. And that's so much easier than when obviously expenses are tight. You're not actually noticing yourself putting away £100 a month or something like that. Right, we do have quite a lot of questions, but I will, as the chair, take the lead of having the first. How are neobanks able to compete with the more traditional banks in terms of lending and helping their customers?
So the new challenger banks are actually they're able to offer lower cost products simply because they have lower cost of servicing. So they have built out modern core platforms, and they are designed to have all of the data available to them. So they are able to more accurately provide data insights to understand customer spending habits and behaviors. And because they have lower cost platforms and lower overheads, therefore they can actually afford to service loans in a far more competitive manner.
Um, got a few questions here from Dan. He's mentioned that a recent teacher survey said that students' financial literacy was extremely poor, and they estimated that under 5% had a baseline knowledge. So obviously the digital first banking is faster and cheaper, but he said it's certainly not better or safer for consumers.
So that's a very good point actually, and it is something that we have come across. In implementing SaltBank in Romania, they had a strong desire actually to implement a child saver account. Um, we do have them in the UK. There are organisations like GoHenry that offer child accounts that are managed and actually help children understand finance and financial literacy. Clearly, not enough is being done. Starling and Monzo, they also have the managed children accounts as well. So actually assisting children to understand things like opportunity cost around spending, they are there. They're not proliferating fast enough, and more does need to be done. And I think the banks certainly have a willingness to offer this because clearly the younger consumer is their future, hopefully, mass wealth if that's what they can foster and forge in better financial wellness. So all the banks are actually actively targeting the youth segment and children in particular to actually help them understand and manage finances better.
This sort of relates to Clive's question. He said, why don't consumers understand the effect that compounding interest has on their debt, obviously being charged more interest, and then on savings with higher interest rates?
That's an interesting one because I, it might relate to the previous question around the lack of sort of like financial literacy. And obviously now we live in a more connected world. It's easier to actually ascertain that level of understanding around people's abilities to understand their finances. But I would say it's twofold. It's also the freely available access now to credit. So I would say that a lot of consumers probably do understand the compound effect that borrowing is having. Um, Sometimes it might be linked to the fact that they are consolidating debt or they are using debt to actually pay off lower rates of debt and trying to manage it in that way. But it's a very interesting question. So I think the answer is it's 50-50. Some people don't understand, whereas others are actively participating through full knowledge.
Mm. And some might have the knowledge, but they, if you can't put food on the table or afford essential bills, you don't really have a choice, even though you know you're going to get charged that interest.
Yeah, and I think that
Um,
was the interesting thing that came from the survey, actually, Charlotte, is that credit cards being used for everyday spending on groceries rather than reserved for big ticket items, that is a concerning trend.
mm, definitely. And I'm sure we'd all love to benefit from more earning more interest in our savings, but if you don't have anything left over to add to that, it's not going to work. Now, Dan has asked, what is a bank anymore? I mean, the definition of a bank, because he said Revolt users in UK believe 90% of Revolt users believe it is a bank. So, what's the definition of a bank? That's an interesting one.
That is an
Is it
interesting
a
one. So,
bank or a bank?
so a bank is somewhere that you keep something precious safe, right? If we take it back to its basis, um, and these days a bank is it could what is precious in today's market? Well, your identity and your data. So if we do start looking at the definition of a bank, data and identity security have actually become far more key than access to money and savings. Obviously, we want those to be kept secure as well. But with things like embedded finance and open banking, access to money has become sort of far more prevalent across the entire market, and every single store, website, etc., can help you to access your funds directly without actually interacting with the bank. But when I start thinking about what is the difference between regulated and unregulated, it does come down to that definition of security. So if you're saving with the likes of Revolut, who are not licensed as a bank in the UK, they are across Europe, but not currently in the UK. There are certain additional benefits and securities you get from having that banking license.
And are they not registered in the UK as opposed to Europe because there's more regulations in the UK, or do you know why?
So they started as an electronic money institution, and I think they're fantastic. So no words against. In the UK, there have been challenges, and they're not necessarily to do with the products and services they're offering. They're around compliance issues, and they've been widely documented. And Revolut has continued and probably will continue, even if they say they might actually pull out of the UK market. I suspect they will continue to reapply for their banking license, and ultimately they should actually receive it.
Okay, interesting. Um, we've had a few questions around whether banks have a responsibility to help educate their customers about financial literacy and costs of borrowing and that sort of thing. But then Dan's also pointed out that banks obviously profit from fees and interest. So what incentives do they have to oblige with the FCA's consumer duty?
So they 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 are required to comply with fair treatment rules. But actually, I would argue that even though banks do make money on borrowing, there is an inherent incentive there to maintain their customers' well-being financially, so that actually they can afford the debts that they are taking on and repay the loans and credit facilities in order to have a longer term relationship with them. Banks, obviously, if they went for short-term gain and just went for, profit today, they would lose then the benefit of making additional fees and charges for additional services over a longer period of time and maintaining a healthy, longer relationship with their customers.
That's very true. Kay's got an interesting question here. Obviously, now banks have so much information on their customers, budgeting, spending habits, money goals, intentions of saving pots and things. Can this information be misused for marketing purposes and other things?
So there are strict rules that banks, like any other company, have to follow, especially around things like GDPR. That data can actually only be stored and used for the purpose with which it was collected. So that's a primary enforcement on GDPR. So whilst banks can use the data, they have to be very careful that it aligns to that initial purpose that they made a pact with the customer that they would store and keep it for.
Okay, that's good to know. Shane has asked, did your index show with, I think that, the concept of like services like Klarna, Afterpay, Buy Now, Pay Later, they've suddenly increased a lot sort of within the last 5 years. Has that contributed to the increase in the credit burden on consumers, or is it more traditional credit card debt?
Well, what we've seen is that consumers are actually using credit cards in replacement of traditional overdraft facilities. Um, and they seem happier to be doing that without understanding the additional fees and charges that they're incurring above and beyond traditional overdrafts. Many banks offer uh, interest-free overdrafts to a certain amount, and it would seem as if consumers are just not leveraging the better financial products and services available to them. They are resorting to revolving credit, which obviously has higher interest rates, fees, charges. That is concerning. Driving that might be the access to credit, the increased use of buy now, pay later. So therefore, going to um, pre-agreed revolving credit might actually be more favorable to them than going to the bank and utilizing those overdraft facilities.
Interesting. Because I know with the buy now, pay later, if you pay it off in time, you don't get charged any fees or interest. And obviously it's smaller amounts, so it might be easier to do than with credit. Hugo has asked, what major product innovations have been introduced by these, digital neobanks or are planning to be introduced that will have a major impact on traditional banking?
So the ones that have been introduced, I think you touched on it yourself, Charlotte. The idea of rounding up, that was actually introduced, uh, you know, a little while ago. Since then, you've had organisations like Maniga, Personetics, Tink, Moneythor, offering digital services around understanding your financial management through data analytics. And obviously, as AI has improved, the understanding and data insights and proof points to actually demonstrate areas where you can improve your your interaction with your money that has all improved and is ever continuing to improve. We've seen things like savings spaces and savings pots being introduced so you can actually set yourself goals. There are joint savings goals so that younger people especially can set up a joint shared savings goal with their own individual targets to save for a friend's holiday, for example. We're now seeing this idea of budgeting or spending pots, as I said earlier, around individual aspects of your spending categories so that you can understand and manage how much you spend on entertainment as opposed to how much you need to spend on groceries.
Yeah, that's helpful. Also, we've had a few questions around sort of the digital banks being recognised as a bank and whether consumers trust them with their money if they're not registered. And we did talk about Revolut not being registered as a bank in the UK, but I know other sort of more neobanks are, like Monzo is, and I presume there's some other banks that are recognised in the UK and have that assurance with their savings and things. Is that correct?
That's correct. Yeah.
Great. Right. Gosh, we've got a lot of questions. This is great. Okay. I mean, in terms of credit card debt being bad, is there a case of bank customers using their funds more wisely? I mean, is it? I think consumers can be quite overwhelmed at all the options.
So when we look at credit cards, and actually this goes back to the previous question. So um, banks are, or credit card providers are not allowed to actually do any sort of analysis around what you're spending a revolving credit function on. So they can't actually do spending insights on a credit card in the same way that banks can do that on your current account. So if we think about traditional PFM of old, where it was just considered pie charts, where you'd log on and it would give you a pie chart showing you that you were spending this on transport, this amount on utilities, this amount on groceries, etc. That's not something that any provider of a credit card can actually give in terms of insights. So when you start using a credit card facility as opposed to your current account with a stretch facility around the overdraft and managing your finances using the tools they provide, the credit card can't do that. You've got a revolving credit. A lot of people are not actively looking at the amount they're being charged every month and understanding what impact that is having on their overall financial wellness longer term.
And do you see more innovative services being offered over coming years that will help with this sort of challenge that consumers have?
So yes, we're seeing a massive increase in embedded finance. So I think embedded finance is going to really shake up how customers interact with their finances. Um, I do worry that that does actually distribute that far more widely, and that distribution might ultimately make it more difficult for consumers to actually track where they're spending and how they're spending. If they've got multiple providers within embedded finance, that will mean, I suspect, that their banks will actually have to step up and do more to actually help them to understand who's accessing their funds and how often.
Um, Kevin has asked about customers' consent to use this information for data processing. And he said the GDPR provides very limited protections. And if a customer does not give their consent, then typically they don't get access to the service they require.
Um, so they do give limited, but at the same time, it's very targeted. So you have to be very careful that you are actually only storing. So when you look at the terms and conditions and you're giving your consent, the terms and conditions actually do specify the purpose for which the data is actually being collected and stored. You can't actually store any more information than is needed to do the task or activity to fulfill the purpose that you're outlining. So it is very clear in what it's saying. And I know when it comes to terms and conditions, few of us actually do actively read all of the terms and conditions to that finite degree to understand. Um, but again, consent for marketing is often separated from the consent for access to your data in order to receive a service.
And I guess there's always those who do choose to bury their money in the garden or hide it under the bed or something like that, isn't there?
There is.
Yes. Dan has asked about sort of as we transition from open banking to open finance and eventually open data, do you think banks will be on board to share this across the ecosystem to benefit people, business, and government?
Um, it's interesting. So from my experience in Romania with Saltbank and Engine by Starling, the Romanian government, because of historical setup within the country when it was under a former communist authority, the banks actually have to share practically all information that they have with the government. Um, it's one of those things when government has access to your data, they rarely give up that access easily. When governments don't, they make ever smaller changes in the regulation to get more access to your data. So as an evolutionary aspect, I think it's inevitable that governments will get more access to our data. But I think hopefully we can fingers crossed it will be a long time coming.
And I guess that also depends if you trust the government in your country or not, doesn't it? With the
It's not a topic we should actually
no,
explore given our
no,
current situation with the
very
impending election.
yes, indeed. So with the index, did it look at to what is in terms of age? Is there a generational gap between the people who use the sort of neobanks or who use the more traditional banks?
It's interesting actually. It's kind of split. We haven't been able to go down to the individual level of each bank to understand the breakdown of ages. Um, I know from my experience of working with different organizations, I find Starling Bank are very attractive to a mid to older age demographic, and I think that's because of the persona of the organization. They are actually attracting um, many younger through their child account, which offers really good digital services and functions. I think Monzo hit the market and immediately connected with the young aspect. A lot of that to do with it again, its persona and its bright marketing and its flashy card, and the number of kids that have told us that they can't wait until they're 16 to have a Monzo card. So they have generated a lot of excitement amongst the youth aspect.
And in terms of like the services that these digital banks offer that people might be more inclined to switch banks for, like being able to spend overseas without international currency conversion fees, and as well as just fees for using a card, or fees for using ATMs. The sort of main major banks in the UK trying to sort of cut their fees in this area to make themselves more competitive.
Um, so it's actually quite interesting because many actually are. They're looking at leveraging sort of like the cross-border services of the likes of Currency Cloud, Visa's Currency Cloud, and Wise to actually offer lower cost international transfers. Um, Many haven't seemed to have made a lot of progress in that space, and so there's often more that they can do, but that will ultimately be driven by the consumer and consumer choice. So what we did see when we looked at cross-border was a very high percentage of responders actually said they have a digital challenger bank like a Revolut, a Monzo, or a Starling only for spending money overseas to leverage that cheap overseas spending. So that was the more sort of financially savvy had already started to migrate to those digital challengers that offered the lower cost products.
And I guess that would be with the major banks. A lot of credit card spending would be from their consumers when they are overseas. So that's something they should definitely look at, I think. With
Absolutely.
the, I know obviously, as you said, GFT operates in a large number of countries, and this report is specifically focused on the UK. Do you have similar indices for other regions, countries around the world?
So as a we do. We launched the index in 2022, and initially we launched it as a quarterly index, and we were looking to gauge trends across the piece. The level of success has actually now expanded the BDI so that we now run it across 6 different countries and growing. So there's greater levels across GFT in all of those 20 countries to understand how they might be able to adopt the Banking Disruption Index and apply that to their own territory. So, we're hoping that ultimately we'll be able to cover a far wider area and bring that all to bear so that we can actually start looking at some global research and bringing together trends across multiple different geographies to understand more insights as this grows. But as it's grown, we've had to move it to 6 monthly, simply because of when you're starting to do a global index, you have to coordinate with multiple different geographies, and it's a lot more difficult to coordinate. But the data insights we're getting are a lot more in depth. Um, so I believe it will go from strength to strength.
Yeah, I think a lot of our audience as well would be interested to see how the different regions compare. So I think, and even like say 6 months from now, we might have to get you back to see if the debt situation has improved. Fingers crossed, and who knows how the economy will be faring then as well. I think we're about almost out of time. So was there any, I also had a few other questions about accessing the recording and the PowerPoint slides. They will be up on the website within 2 days, and you'll also be sent a link to them directly to your email. Was there anything else you wanted to add before we sort of say
Well,
goodbye to everyone, Richard?
Well, if anyone is interested in seeing the results or responses from other countries, all of the Banking Disruption Index, and you have this available on the screen now, they are all available to download, the different reports. The UK one is listed here, but the others for the other countries are readily available. And we can make those available if people can't actually find access to them.
Thank you. And Richard's email address is up there on the screen as well, so you can feel free to get in touch with him directly if you have other questions. I think fingers crossed we got to everyone today. Um, So yes, it's just up to me now, I guess, to say thank you very much for sharing your time and expertise with us, Richard. It's been really interesting. And
Pleasure.
thank you to our sponsors, especially GFT, for always keeping us up to date on the banking and fintech trends. We have got lots more coming up over the next week or so. Diverging to talking about autism approaches and virtual reality, sustainability, and investment opportunities, to make land more sustainable. And so you can register for them on our website. So I hope everyone has a great rest of the week. And thanks very much again, Richard.
Thanks, Charlotte. Good to be back.
Goodbye.
Bye.